Okay, welcome everyone. This evening's webinar. I'm sure if you've been in property, you're also very worried about what the property market is doing right now. What actions that you should take, and I'm going to cover all that. But above all, what I wanted to say to you guys is that, last year, if you ever heard me give a talk. At that time, the markets, I felt very, not only uncertain, but I've been very uncertain about the markets because I do a lot of data mining, basically, and looking at various things which I'll cover in the talk now. So that's me. I mean, Infinity Wealth, I'll cover Infinity Wealth and what, why we brought up Infinity Wealth. One of the main reasons was, what I felt was wrong in the industry was that a lot of people paid a lot of money in doing courses, basically, and I felt that it was wrong in doing that. What we wanted to do is try and provide a community where we're very hands-on. We want you to be successful above all, and we want to give you as much value for money as possible. So what I'll do is I'll tell you, for those people who've never met me before, I'll tell you a brief background about me. Okay, so got an issue already. Okay, yep. All right, guys. So who am I? Who is Dr. Marttand Patel? I've got a PhD in chemistry. And I've got 2 European fellowships and also 13 international publications. Now, I started life as a chemist. My work was outstanding, which is why I was given the 2 European fellowships in Europe. I was one of 3 people throughout the whole of Europe selected that year to get the fellowship. And I went off to Europe, went off to France, I went off to Holland to do the fellowship and linking research together. It was very research based. After which time I came back to the UK, and if any of you remember, I've been in property and in business for over 35 years, basically. So you can tell by the grey hairs. So if you were around in the 91 recession, when interest rates went up really high. One of the things was that when I came back to Europe, I was at the top very 1% of my echelon, basically. The job market was quite tight, but equally, my father was really, really struggling. Now, what had happened is that my father lost his business, but he also had personal guarantees with the bank, and he was in a pretty bad way. So I decided that, maybe I would take a little bit of time out and help my father. Now, he was in textiles, but the way he was doing things was completely the wrong way to go about doing it. Me being me and very proactive and being able to fly all over the place. We set up a new company in textiles in women's fashion. So yes, I went from a chemistry lab coat and doing research to women's fashion. We were supplying the Wallace stores and all the multiples, basically. So we managed to create, and how we did that was because of my experience. I flew out to the Far East, so I cut out all the middlemen. I flew direct to the suppliers, established supply chains, brought the fabrics over, and we were very, very competitive, and then set up that business. And we went from 0 to 2 million turnover in about 2 years because of our price structure. Now, I'd made a lot of money in textiles. But unfortunately, I was also interested at that time, the money market accounts, because we had a lot of surplus cash, wasn't really paying much interest. So what we did was I went into trading. I was trading at the time. I don't know if you remember the stock .com bubble. And I was making 3, 4, 5, 6 grand a day sometimes, just picking it up in the evening and then selling it in the morning because everyone was, rah-rah. Buying stocks as soon as they saw it in the paper. But I had the Reuters news feed, so I knew what was coming up, and I'd pay for that subscription, so that was brilliant. But unfortunately, I got caught out. And where I got caught out is I held on to these tech stocks and they just kept going down and down. And I thought they'd come back. They never did. And I lost all the money that I'd made. I picked myself up, went back into textiles. Now, one of the things that I am very good at is looking forward, which I hope in this presentation you'll see the amount of research that I do, and it'll be very insightful to you. With that, I went back to textiles, made as much money as I could because I could see the writing on the wall. It didn't make sense to actually bring raw materials from the Far East to the UK, then to manufacture them in the UK when there were factories now in the Far East, and I could see that progression developing. So I went back into textiles to make as much money back as possible. After which time, I trained myself as a trader. So I took a lot of courses, finding out, what had gone wrong. Again, I was successful at trading, but then I got caught out again, believe it or not, with Northern Rock, where I had, if any of you know CFDs, I'm a very, very extreme trader. I like trading extremities, but there's certain times when you shouldn't, and that was obviously in the banking crisis because everything else, it doesn't work. Those parameters don't work. Unfortunately, I had 250,000 shares of Northern Rock on margin, and I almost lost my house. I had to borrow money from my father, which to pay off my margin calls basically, and I started again. Now, at that stage, I had a wife, 2 kids. And it wasn't easy. The first time was easier because I had my wife, and only us. There was no kids involved, So dusting myself off was easier. Second time round, it was very, very hard. And it was the mindset that is required. Don't get me wrong. I didn't immediately bounce up and do it. It took me a bit of time, one, to forgive myself, and then to actually build up my self-esteem. And this... The amount of self-esteem that you lose in taking a hit like that is absolutely immense. After which time, I've been involved in property the whole time. So I've done a flip, but I wanted the fast buck. And I'll be honest with you. So, that's why I was doing trading. But at the same time, I was involved in property. So going to auctions, looking at deals all the time. But felt, if I'm making that much money in trading, why am I going to go into property? But that was a mistake at the time. But what I did from there, after I'd lost it all, second time, I set up a solar company. I am passionate about renewable energy, and I've always been passionate about renewable energy, even today. So I set up my solar company, and again, it was a case of timing, and this was in the recession. And I always say the best money is made in a recession. If you position yourself correctly, the best money is made in a recession. I hit the solar industry at the right time. We went from 0 to 2 million turnover, and I was back. And this time, I went into property big time. The reason why I did that was also because to safeguard my family's future. That was the main thing that I went into property. Now, since then, I've been a mentor. I've also done business coaching as well to people. And how Infinity Wealth was created, I'll go on to that, was because after having lost all that money, I was taken, my father actually said, look, let's do a pilgrimage, and I was in a pretty bad way. So we did a pilgrimage to India, and we went to all the temples and everything else. Now, what I saw in these temples is that, just like typical is in every religion, they all seem to be, well fed, but the poor outside weren't fed. And I had, in all the temples that I'd visited, I'd made a solemn vow to God that if he actually put me back whole, that I would dedicate part of my life to help the poor. And that's what I do. So a lot of my, I travel back to India and I help underprivileged children. So, typical example is the picture that you see there. These kids, they in India, there's a disparity between those people that have money that are able to send their kids to private school and those ones that have to go to state school only just so that they can go to work. But what we wanted to do was, I went around all the schools saying, what do you need? Now, they thought it was laptops, or I thought it was laptops. But instead, what the teacher has said to me is, look, I want to build up the kids' self-esteem. So can we supply uniforms? So we clothed, 500 kids and more now, got them uniforms and everything else to bring up that self-esteem. And that really resonated with me. And that's what I'm constantly doing. So I am now also supporting disabled schools in India, where disabled kids, don't really have the right the right support there. So we're providing food for schools that take these disabled kids. So that's me in total, right? So I hope you've got a good background of what I do and my experience. So let's again, I've been in papers in India for the charity work that I do. In the photographs, that's my father and my sister, and we've set up a charity there to help underprivileged kids. Okay, so winners and losers in Brexit. I'm sure that everyone is very worried about Brexit at the moment, and also about the possible recession. Look, you have to use this time to actually learn and position yourself so that when opportunities come about, you know what opportunities to take. Now, Infinity Wealth, before I go on to that, Infinity Wealth, the reason why we created Infinity Wealth was to, again, help people. When you've made money and lost money in life, you'll realize that money is not important. What is important to me and my co-host as well, Kiki, is that we make a difference. I'm sure all of you want to, on somewhere in your dream line you've got that you want to make a difference, which is hence why Infinity Wealth was set up to make a difference. Okay, so as property entrepreneurs, what should you be looking at? Okay, I look at constant economic indicators. So the first one, GDP growth rate. As investors, as property investors, really the key points that you should be looking at is interest rates, employment rate, and housing index. Why interest rates? Well, if you've been in as many recessions as I have, I've been in 3 now, and if this one comes along, it'll be the 4th one. Interest rates, when interest rates come down, you tend to find that asset prices go up. Unemployment obviously goes up as you get deeper into the recession, and obviously housing index comes down. I look at all these indicators all the time, but tonight what I want to do is concentrate more on property and what property investors should be looking at. These are the indicators that you should be looking at. I've got Reuters news feeds and all sorts of things where I get information all the time. Another thing that's important, which has changed my mind a little bit about, I think there will be opportunities coming very, very soon, and people will blink and they'll miss it, is MMT. Most of you will not have heard of MMT, I guarantee it. Now, MMT, unless you've been in the industry, and that's the financial markets, MMT is modern monetary theory. Now, I'll cover that shortly as well and telling you about that. So let's take a look. So if you consider the UK house price index over the last 20, 30 years, you'll see that we've had a nice steady rise in house prices. You can see now it's beginning to tail off a little bit. But let's look at interest rates, which I think are important, right? If you look at interest rates in Japan, what I did, and this gives you an insight into how I think and how deeply I think about things. So one of the things that I started questioning myself about is, okay, so where in the world have interest rates been so low for such a long period? Because you and I both know that the Bank of England is going to reduce interest rates. Now, in Europe, we've already got negative interest rates. This week, Greece actually issued negative yielding bonds. Believe it or not, of all places, Greece. And they had a take-up of these bonds. So what does that imply for us as property investors? It's very important. Now, obviously, if you stay with us all the time, I will give you current market updates on what's going on, not just in the financial markets, but also how that's going to affect our property market. So I looked at Japan because interest rates in Japan have been 0 for a very, very long time. As you can see, and more importantly, Japan has had the least amount of growth out of most of the developed nations, basically. So I thought, okay, so if they've had low growth, how is that going to affect house prices? Let me take a look. And this is how I started my research. Okay, so you can see clearly that Japan, the house prices in Japan have still steadily risen. Okay, there's been peaks and troughs, but it has steadily risen. Okay, so UK interest rates, they've been at 0.75 and they've been dropping. So I anticipate UK interest rates, and there is talk, guys, that we will go to zero. There is talk that we could even go negative. Yes, negative. Now, there is another country in Europe, Denmark. I don't know if you've caught the news. Denmark has actually got negative interest rates. And if you take out a mortgage in Denmark, they will actually pay you to take out a mortgage. How bizarre is that? Now, that will obviously support asset prices. Now, I actually thought about going to Copenhagen and buying a property in Copenhagen. Interesting. I am going to be doing that research to see how that market is developing. So it will give us more of an insight into what's going on in the UK. Okay, so interest rates in Japan, like I said to you, they have been zero. Take a look at this graph. They've been zero for over 10 years. Now, with them being zero, the growth rate has not increased. Our growth rate, we're lucky in the UK, our growth rate, GDP rate, is still okay. Okay, Brexit has affected it. We're not quite in recession. Germany is in recession. So the whole of the Eurozone, at the moment, is $17 trillion worth of negative yielding debt is coming to us soon. So we can't stop this tide, which is why modern monetary theory is coming into play. Whether it happens or not, I don't know. But as property investors, it will affect us and it will give us an opportunity. So unemployment. The other thing that affects property prices is unemployment. Obviously, if unemployment is high, people can't pay their rents. People can't buy houses. So one of the indicators that you as property investors should be looking at is the unemployment rate. If you haven't got time to look at it, don't worry. Come to Holborn and we have monthly meetings free of charge, and I'll be covering all sorts of things, what's going on in the market, and really keeping you current, free of charge. So if you look at interest rates unemployment rates in the UK, you'll see it's at 4%, right? Now, that's quite low. That will rise with Brexit at the end of the day, okay? So if we look at Japan, which is important, because I said to you my research revolved about Japan, because I wanted to find out how Japan was affected, because perhaps we're going to be entering into that Japan scenario. So unemployment in Japan has been dropping, but I bet most of you don't know why it's been dropping. Now, the reason why Japan's unemployment has been dropping is that they've got an aging population. It's as simple as that. Now, if I was ever to set up a robotics industry business, I would go to Japan. Japan is the leading country at the moment for robotics. The reason why they're investing so much in robotics is because they are wanting to fill that workspace void. They haven't got enough people, and obviously the more people that you've got coming in the workplace, then you're able to support those people that are retiring. It's very important, which is the main reason why Germany opened its floodgates to so many refugees, because they need people to come. Again, Germany is an aging population. You know, we in the West do have aging populations, so we do need an influx of people coming in to contribute to our economy, to thereby support those people who are retiring. Yeah, one of the main reasons why I went into property is as to safeguard myself, but also for retirement as well. And obviously, it's done far more than that than I anticipated as well. Okay, so what is modern monetary system? Most of you have not heard of this. You can Google it. Okay, the reason why this is important is because the Democrats in the US are already talking about it. This theory has been around for some time. Now, you've all heard of QE, I'm sure, quantitative easing. It's where governments actually buy bonds from banks. Now, this is a good way of supporting banks, which I don't like. It was to safeguard the banks. Modern monetary system is actually expanding the physical balance sheets of nations. Normally, a nation is geared. You know, you heard about austerity in the UK, right? Austerity in the UK was brought around to actually reduce our debt ratios. Now, modern monetary theory goes like this. Basically, you can expand your debt. by expanding your debt and printing more money, guys. Remember, you're printing more money. That more money is going to be then injected into society. This way, they are talking about in the States to actually give it to regular people, everyday people, and inject and give money to people. Where they will control that money supply is through taxation and control that excess money supply and claw it back, but increasing growth. Now, this is just a theory. If that happens, can you believe what will happen to property prices? This is why I'm saying it's important. Now, my findings have changed. If you ever heard a talk that I gave a year ago or 2 years ago, you'll find that, I was very negative. I still am negative, but I've also got the mindset, this in the back of my mind. And if you work with me, you communicate with me, I'll keep you very, very current. So that's modern monetary system. So let's go on about winners and losers, right? Which is why you're here as well. I wanted to give you that update so that you understand better as investors what to look for, Okay, so the losers. Let's go through the losers. Developers. Now, the main reason why developers are going to be losers is if you've ever done a development like I have done developments, you cannot time the market. Developers find it very, very hard, especially the larger developers. So in the recession, you saw larger developers, share prices of larger developers dropping. The reason why it was dropping is because the land value banks were falling in price as well. So developers find it very, very difficult to actually time the market. They also have an extended sales period right now. So with Brexit, a lot of people are putting off buying new flats, new homes, because they're not sure where Brexit is going to be. So developers are finding it very, very hard to actually sell things in the marketplace at the moment. The other thing that you've got to be aware of is when you're a developer, in a recession or in a down cycle, your GDV will be dropping, right? So whatever GDV that you had initially, it will be less. So I always say, to safeguard yourself, always reduce your GDV. If you reduce it by 10% and the numbers still work, that's great. Now, if any of you have revaluations done recently, you'll find that all the Institute of Chartered Surveyors are now down valuing all properties. That's to be expected, guys. That is what happens in an uncertain and a dropping market. Because at the end of the day, mortgage lenders want to try and safeguard themselves as much as possible. The other problem that developers have is funding. Funding is key. Cash flow in any business is key. If they've got high debt, high leverage, and they're not selling enough stock, what do you think is going to happen? So cash flow is all important. Market sentiment is also important. How do you control market sentiment? At the moment, property market sentiment, you've seen it everywhere. It's quite negative, right? Now, it's good that it's negative. For us, those people that wait, there will be great opportunity coming. So that's why I say, work with us and we'll show you the way. Also, in certain parts of the UK, so if you take Slough, for example, I was doing a mentorship in Slough. Slough has got a whole load of flats at the moment that they cannot sell. Those flats are at 250,000 for a one-bedroom flat, right next opposite the Crossrail station, which still hasn't been built yet, or having an issue. They're still not selling. Now, so anyone who'd bought a flat, let's say 6 months ago, is actually in negative equity now. You've got to be mindful of these sort of things, yeah? In Liverpool, in Manchester, there is an oversupply of flats. So don't be going and developing flats in Manchester, Liverpool, or even in London, in places in Slough. So you've got to be very, very careful and pick your areas really well. Working with us will show you how to do that due diligence. We will show you, because that's what I've been doing all my life. I hope you can see that, the level of research that I've been doing. The other thing that's been happening in the London market, especially, is with the onset of the higher stamp duty thresholds. Obviously, high-end developments are really struggling to sell. Now, I know loads of people that have got houses over £1 million that are struggling to take off the books. And the longer they wait, it's going to come down. Unfortunately, as long as you can ride it out, that's great. If you can't ride it out, yeah, the banks may well repossess you. So developers, it's a dangerous market. What you have to remember as a developer is you can't time it. The bigger developers can't time it. It's their business to buy, build, and sell. If they don't do that, then how can they make money, right? They cannot go back to your shareholders. As individual developers and smaller developers, we can actually control what we need, because sometimes we don't need to develop. It's better sitting on your hands and waiting it out. There's a lot of eager beavers out there that want to do it. Me, what am I doing? Yeah, I want to do developments, but only certain developments that that fulfill my criteria, which I will share with you, in other things basically in courses. Okay, so that's developers. Who else is going to suffer? Portfolio landlords who are over leveraged. There's quite a few of them out there. Now, if you've got high gearing in your portfolio, remember one thing. If you look at your mortgage term agreement, you'll see that it's 75-25 loan to value or 80-20 loan to value. Now, if the market drops by 25%, 20%, and it's happened in the recession, in the last recession, where banks had to sell some of the stock that they already had in their order books to actually reduce their exposure. Now, if the property market has dropped, the banks are well within their rights to come to you and say to you, actually, we've done an agreement of 75-25. Unfortunately, you will have to inject another X amount of money to keep that threshold. Otherwise, we may have to sell the property or find other ways of doing it. They're well within their rights. So highly leveraged portfolio landlords, if you are overgeared, you will suffer. So my advice to you is try and pay down some debt at the moment and don't over leverage yourself. People buying off plan. If you're a professional investor, I'm sorry, but if you buy off plan, you're a muppet. The reason why I say that is professional investors don't buy off plan. Amateur investors buy off plan. The reason why professional investors do not buy off plan is because the builder has already built in quite a colossal margin for himself. So just like Slough, take an example. If you buy a flat in Slough today at 250,000 and you sell it tomorrow, they won't give you the 250,000. It's a second-hand flat. New flats obviously achieve that 250. It's better as an investor to pick up a deal. So, okay, go to some of these companies and say, I'll tell you what, I'll buy a number, but at 200. Don't buy off plan. I'll give you another example. I had a relative who bought in Liverpool at the height of the property market in Liverpool, a one bed in Liverpool for 170,000 because he had some sort of guaranteed rent. Don't do that. As a professional investor, do not do that. What you're doing is, what they're making you do is actually pay up front and they're paying you back through that guaranteed rent. Now, once that guaranteed rent goes out, that's it. He was stuck. So he was actually getting a lot less and it's just about washing its face. And it wouldn't have been washing its face had interest rates not come down. Landlords who have to refinance in London. Now, I am a Londoner. I have properties in London. This is very important. I have a number, I work in a different level to most of you. Now, the level I work at, I was talking to one of the guys that I do financing with, and he and I sat down. I said, look, he said to me, there's lots of people struggling out there still. I said, how are they struggling? He said, well, before the model used to be you buy, refinance, buy, refinance, buy, refinance. Now, if they've held properties in London for over a long period of time, what they've been doing is refinancing, pulling the money out, buying a new property, pulling the money out, buying a new property. Okay, that's great. But when Section 24 has come in, the main problem is the lending criteria and the lending ratio has increased. So basically, these guys now, with interest rate, even with interest rates, unless they go to zero or go negative, that's fine. But at the moment, they're finding it very, very hard to actually refinance because those numbers no longer work. They no longer work because the amount of free cash flow that they're asking for, the ratios, is a lot higher. So they're starting to struggle. Now, you need to actually look for these sort of guys because that presents an opportunity. they will need to sell. They will need to sell because they can't refinance. So they may be stuck at their old rates, and the rates used to be a lot higher before. The next ones are people who flip properties, but they don't do the numbers. I'm not saying flipping properties is not right. Now, we went to an auction recently, and I say auctions are a good place, especially in a recession, to find out where the deals are. I like auctions, especially in recessions, because everyone is scared. And I normally enter markets when everyone is scared, when there's a lot of negativity around. I like it that way. So people who flip properties, who don't do their numbers, we will show you how to do due diligence. You need to know that to protect yourself. Build enough margin. So understanding the marketplace. So what they've done is they've thought they're getting a deal. They're not really getting a deal. They've overpaid for building costs as well. They haven't understood their market, and they're now flipping that property. And that also goes through revaluations as well. So if you're looking at revaluations, make sure that your numbers still work, or that you're happy to leave money in the deal in order for that deal to go forward. Okay? So always make sure. Flipping properties is a great industry, but remember, when you've got a downward sloping property market and prices, flipping becomes difficult. Flipping is a lot easier when you've got an uptrend, right? And stick with us. I've done uptrends, downtrends. I know what the cycles are, and I will convey that to you and when to go. Okay, so flipping properties are also going to be losers. Anyone in negative equity. Now, for those people who are actually investing up north, remember, there's still parts of the UK up there who are in negative equity. The reason why they're in negative equity is because unemployment rates are very high up there, and industry hasn't actually developed up there. You know, new industry hasn't come in. They've been with the old, shipbuilding, fishing, and unfortunately, you know, there are areas like Scunthorpe and places like that where prices haven't quite risen. Newcastle, where prices quite haven't risen, and people are still in negative equity. So if we do have a downturn, they're going to be even worse off. Okay, for those that need to sell quickly. So there are going to be people that need to offload properties. One of the things that I saw on Facebook recently was a guy who'd picked up a deal of a lady who is an international investor, had bought a property on bridging, but now can't actually refinance it. Because she's from abroad, she can't get a mortgage. She'd not thought about how to actually refinance it. She's got it on a bridging loan. The bridging loan company wants its money back. She is prepared to sell it for $200,000, and the valuation of this property, according to Facebook or this particular person, I don't know if he's done his numbers correctly, it was 325. Now you can see those advantages that coming in, and those people that selling quickly. Okay, so those people that don't take advantage of lower mortgage interest rates. Now, with interest rates being low, a lot of the questions that I was asked, I did this talk recently, and if you want me to present at any of your property meets, let me know, and I'll be happy to do that. So those people, some people have said to me, well, should I wait before interest rates go down further? What my saying is that I always still try to lock in a five-year fix. At the end of the day, if the property is washing its face and you're getting plenty of cash flow, interest rates and mortgage bond rates are dropping at the moment. So I actually have got 2 HMOs which came up, well actually it's a block of flats and an HMO, that came up for refinancing recently. I've held them for a long time. I've got very, very good debt to ratios on there, below 50%. I was actually offered the refinancing deal fixed for 5 years at 2.49, right? That's unbelievable. Whereas before I was fixed in at 4.49. So you can see those advantages. So those people who have got, are unable to take advantage of these because of Section 24 and have got high gearing, they're going to be the losers. Also, because people don't know timing, right? Most of you that are on this seminar or webinar have not timed the market, or guaranteed that you've not lived through cycles like I have. So because of my experience, I know where the cycles are, and I know when the corrections are over, or I can guess when the corrections are over because I look at economic data as well, where most investors don't. They're very frightened at that stage, and I say, okay, it's time to go in and buy as much as you can. So those people that overweight, basically, timing is all important. And once again, working with us and understanding market cycles will really help you. Those people, right, so this is a contentious issue, okay? The reason why it is because, you know, most of you have seen these guys on Facebook, on everywhere, rent to rent. Okay, so let me ask you one simple question. Remember in mind that I am a property business guy and a business guy because I've done many businesses. Rent to rent will suffer in a recession. And those people that do service accommodation will suffer. Do you know why? Service accommodation is a hotel. That's what it is. It's a hotel. Rent to rent is actually a lettings business. Now, if you came into property wanting to become a letting agent, that's great. But if you came into property wanting to be an investor, that is probably not the correct course for you. But remember that, you know, a lot of people get sucked in. Rent to rent is actually a full-time job at the end of the day. Now, if you've actually done a rent to rent, and I understand rent to rents, right? If you've done a rent to rent, you've got to pay the landlord a certain lump sum every month. Now, in a recession, what you're going to find is less and less people can afford to pay certain rents. So you've got to be very careful, especially with service accommodation. If you've got hotels in London or hotels elsewhere that are in a recession, they're going to be reducing their prices. So remember, you're competing with well-established names on service accommodation. You've got to be mindful. I'm not saying that service accommodation doesn't work. What I'm saying is you need to understand your marketplace and your position in that marketplace. I can help you understand that. I personally, you know, for service accommodation and rent to rent, I am a businessman, I am an investor. If I wanted to open up a rent to rent business, I would open up a lettings business because then I've got less liabilities, right? My customers have got liabilities, I've got less liabilities. Service accommodation, as a business guy, if I wanted to do that, I would buy a bloody hotel. It's as simple as that. There are lots of hotels out there and if you're ever interested in a hotel deal, I can send you some. In fact, today I was offered 2 deals in East Sussex, in Bournemouth, where we've got hotel, and they have actually reduced the price by 250,000, you know, and this hotel actually has planning permission for a HMO. So, you know, if you're going to do that, don't forget, by doing a hotel, you're actually producing goodwill. Once you create a better business, you've got goodwill. So these are the people that, you know, could potentially lose out. Rent to rent and service accommodation is great in an upswing where you've got high demand. So again, do your numbers. Okay, you've got to have multiple strategies. Those people that don't have multiple strategies or do their due diligence are going to be the losers. And there's plenty of people out there. I can see it. You know, I see it all the time. And I'm thinking, you know, you shouldn't be doing that deal. Because what you're going to do is you're going to fall flat on your face. I understand that you've done courses and you've paid loads and loads of money for these courses and you feel you've got to do something. But it's also important sometimes to pick the right deal. Sometimes it's good in an upswing to get in there and dive straight in. Sometimes when you're in a downswing, you've got to be careful, right? So taking those opportunities. People sharing, chasing the shiny penny. You've seen it. You know, you've seen plenty of webinars and you've seen plenty of people on Facebook saying, I became a millionaire overnight. Okay, let's face facts, guys. There are selling techniques, okay? So if you're always going to chase the shiny penny syndrome, you are going to lose. Because the main reason is, why is the main reason why you went into that? You know, always constantly chasing that shiny penny is difficult. And your heart and soul is never going to be in it. It's better to actually plan a certain route and a certain direction and stick with that. And if you do that, you will become a proper investor. So don't chase shiny pennies. Don't be consumed by all these courses that promise you this, promise you that. Because I promise you one thing, the vast majority of people who come on those courses are not hugely successful. Instead, what you find is that they go into doing webinars and there's tons of them out there, right? Tons of people who have little experience, but they go out there wanting to do webinars. Now, I'm not knocking them. Good luck to them. I wish them a lot of luck. But for me personally, if I was doing it, I want to be trained by someone who has lived it done it, breathed it, and if I ever have a problem, he's my man. Okay, so just a quick summary. Where's that summary gone? It's going to be at the end. Okay, so the winners. Okay, this is more important. Winners, cash buyers. Now, those of you who have heard of Warren Buffett is sitting on close to 250 billion pounds, right? It's a lot of money. The main reason why is a lot of very shrewd investors are sitting on their hands because they want to take opportunities that will be coming. No, that downturn I think will be shallow. It will be shallow because of MMT and interest rates falling. So that's what I'm saying. You know, be prepared, but you won't know when. I will show you when and tell you when because I'm monitoring everything. Okay, so in having cash on your hand, you can take advantage of it. You know, I did a JV work course. The reason why I'm doing all these courses is because I can see opportunities coming and I want to prepare our audience for those opportunities. So I did a JV course. It's, unfortunately, you know, you can see the reviews of the JV courses. There was a reason why I did it, because there are people, if interest rates drop, you've got lots of people who are sitting on money. You now need to find these people, keep that cash pile and saying, I don't need it right now, but I will phone you. Please lend it to me. We can do a lot of deals together. So taking advantage of you know, having cash, because the opportunities when they come in will present themselves, and it's understanding market numbers and strategies. There are always different strategies depending on different market cycles, and you've got to understand market cycles. So there's sometimes, you know, where you do options. I love options. If you do options, you know, options really work well in a downward cycle. Why? Because people are fearful that they're going to lose even more. So options work really well. You know, options tend not to work as well once the upswing is done. You know, if you've ever tried to do an option, you know, when we were having a whale of a time, you'll find that those deals are around, but it takes you longer to get them. In an option deal, it's easier to do in a downswing. So it's understanding which strategy you use when, at which time in the market. It's very important. And understanding market conditions. Having a good equity buffer. Very important. Why having a good equity buffer? An equity buffer will also allow you, if there is a downswing, that you are well within that range of mortgage lending criteria. But the other thing is, you can always refinance if the market has come down. Okay, granted, you may get a smaller amount of money. So one of the questions I was asked is, should I refinance now and keep that money in reserve? My reply was, okay, if you do that, you're still waiting. You haven't found that deal. But even if you refinance after the markets come down, granted, you'll get maybe less because your valuation will be a little bit less. But equally, the property that you're buying will be less. This way, there's less liabilities on you. So if you've got a good equity buffer, you are able to take advantage of this. The other thing that will also help you do is the lenders will look at you more favorably and more positively. That's what's important as well. Okay? Maintaining properties to a good standard. I can't tell you that in a recession, what you're going to find is you've got a lot of landlords who have not updated their properties. And in a recession, obviously, less people are renting. Well, you will get people that are renting, but they can't afford to pay as much. We're all competing for these smaller and smaller numbers, basically. So if your property is maintained to a good standard, you will find it easier to rent out, right? You will find it easier to rent out, which is important, remember. And I'm sure most people have done new HMOs. It's great because they're going to look fantastic and you're going to rent them out. But remember one thing, you may have to reduce your rents, okay? Because you're going to find people who can't necessarily afford those higher rents. So as long as you've done the numbers correctly, that's great, and it washes its face. It enables you to sit tight, pay the bills still, make a little bit of money. That's great. Okay, high yielding properties. Why is that important? So personally, I've always done HMOs and flats, and I've done also developments, commercial developments as well. And I like doing developments in an upswing. I don't like necessarily doing developments in a downswing because you don't know when the market is turning. I do like buying certain properties. Don't get me wrong, if I was offered a blinding deal, I would buy it. Now, I think those blinding deals are literally around the corner. And I think people will miss that opportunity, especially with Brexit, if there's a hard Brexit. Because I don't think that that property prices will remain low for a long period of time. Okay? Okay, those people that understand multiple exit strategies. So, you know, when you're buying a project, and I'm not saying anyone not to buy right now. What I'm saying to you is make sure that you've done your numbers correctly, that you've got more than one exit strategy. So if you're doing a development, in that development, okay, so if it doesn't sell, will you be able to rent it out? Pay, if you've got bridging, pay your bridging loan. Can you afford to leave the money in the deal? If you've rented it now until the market turns up again, will that rent cover the mortgage payments that you've got to make? Will it wash its face? These are the things that you have to consider, and you have to have multiple strategies. So I'll give you an example. We did a commercial to resi conversion, very big, where we actually then sold it to a housing association. The main reason why was the lenders didn't find, they weren't happy. We had some of the flats sold, they weren't happy. So we thought, okay, we'll turn it on its head. We know, we had multiple exit strategies, which I came up with our partners, basically saying, okay, we can do this, we can do this, and we can do this. So I all had it lined up, and we sold it to a big housing association. All right, so maintaining their credit score. This is very, very important. Your credit score, guys, is the most important thing. Now, you've been to very many courses that say, hold up your credit card, and you can get a loan on that credit card. Okay, this is where I have issues. If you're going to go into debt in order to do a course, please don't do it. We at Infinity Wealth do not want you to go into debt in order to do any of our courses or anything else. We want you to be successful. Our thing is making you successful. So maintaining a credit score, for God's sake, maintain a good credit score, because even when the market is turned, the lenders make money by lending money out. Always remember that. But they will filter the wheat from the chaff, and that filtering is on a good credit score. So even when I had my big drawdowns, I had a decent credit score because it was built up from before. And I was able to, I did borrow money on credit cards, don't get me wrong, but I had planned it correctly, paid those credit cards back. So there is a time to use that strategy, which I will show you if you need to show it, but not to do a course. Use credit cards to actually bring out positive cash flow, not negative, regardless of what these courses say and how much they charge. It's ridiculous. Okay, so understanding due diligence, very important, guys. You need to understand your due diligence, right? And we at Infinity Wealth will show you how to do that due diligence, especially now. Please be careful, right? It's about understanding where the cycle is. And the reason for this webinar is I think we've got opportunities coming, not too far in the distant future. This year, maybe, right? So understanding and keeping up to date with market conditions. Once again, if you stay with us, we'll give you that. But how many of you spend time in understanding your markets, what you do? Property is a business at the end of the day. When it's a business, you've got to understand who your clients are, what their needs are, what are they able to pay. These are all business acumens, not, oh yeah, I can get, I can rent this room out for £600 or £575, where you haven't done the work and you're going to find it hard to actually rent that room out. So it's doing that due diligence and using the right market strategies at the right conditions. And staying current with market conditions as well, and being flexible. But you can be flexible by buying right. Most property deals are done at the buying stage. If you buy right, it's fine. Yeah. Okay, and treating property like a business, because at the end of the day, property is a business. So treat it like a business. I've been in business for a long, long time, and I know how to evaluate things, put them into and make sure, and especially in downturns, what to look for. The other thing that I haven't mentioned actually, guys, is also, keep a buffer in your accounts. Don't spend all your money. This is where a lot of landlords make a mistake. What they do is they don't keep a good buffer, just in case you have void periods or you have unfilled rooms. If you've got a buffer, it won't kill you. So we always have a buffer. In all our accounts, we have a buffer, which at any stage, if that room is not filled, or the flat is not filled, or the house is not filled, we've always got that buffer. And our buffer is actually a year's buffer. But that's us. Doesn't mean that it works necessarily for you, but you can also have that buffer for maybe 6 months. Now, that buffer, when we think the market is turning or at the bottom, we will use that buffer at full leverage, basically. Yeah. Okay. So a quick summary of what we've covered tonight. I hope you've been enjoying the seminar, and I hope you found it very insightful. Okay. So losers. Once again, we talked about developers. We talked about buying off plan. If you're a professional investor, please don't buy off plan and be fooled into, I will give you 6% yield, I will give you 8% yield of those flats in Liverpool. They're rubbish. You can actually, and they're selling for about £70,000, right? You can go and buy a house in Liverpool for £70,000, right? So why would you buy a flat, a one-bedroom flat, a student flat, where they're guaranteeing you the rent for 3 months, for 3 years? What will happen is after 3 years, I know that those companies close it down. So all of a sudden the management system goes down once they've sold them all. So be careful, right? Do your due diligence, right? Looking to flip, not doing the numbers. So make sure you do the numbers. London buyers you can't refinance. And there'll be plenty of them out there, okay? Those who wait for the crash to be over. You know, its timing is important. Understanding where you are in that cycle is important. Large portfolio landlords as well. Once again, if you've got a large portfolio landlord and you're over leveraged, obviously it can be very, very stressful because you can lose all your properties. Those people in negative equity up in the north, you know, just be careful and mindful. If you are like that, then it may be time to pay down some of the debt and get out of that negative equity, because if the markets come down, you've got a good credit score, you'll be able to borrow more. Those that need to sell urgently as well. You know, there'll be plenty of them around coming up, guys, right? Especially if unemployment begins to rise, there'll be plenty of them coming up. Those people that are unable to take advantage of lower interest rates, we discussed that, you know. So you need to make sure that book some of them in. So maybe you put some on 5-year fixed, some that are floating just in case. That way you've got a nice balance. Because the other thing that you've got to be mindful of, and which is why I fixed some of mine, is the Bank of England base rate at the moment could easily shoot up. You weren't around in the 90s where interest rates went, well, you might have been, but you may not be aware, went to 15% plus, basically. The reason why they did that was because the pound had to stay in the ERM. Now, if we get a hard Brexit and the pound takes a steep dive, Governor Carney will have to actually try and support sterling. The only way you can support sterling is to put up interest rates. Now, that is an unknown. Don't forget, we're talking about reducing interest rates, but it all depends on how things pan out. The market analysis is dynamic. My market analysis is dynamic, which is why I think there's an opportunity coming. But at the end of the day, there is also the unknown. So you've got to protect yourself as well. So what my advice would be is, okay, you book a few in, 5 years fixed. Interest rates are low anyway. Bond yields are low, right? And you keep some on floating. If it drops even more, that's great. So you've made it bit. But at least you've got some sort of peace of mind. Okay. The other ones is that, the ones that are doing rent to rent and SAs, please be careful. You know, as long as you've done your, the thing is, there's loads of people selling rent to rent courses and SAs because they feel that this is the best way to get into property. Now, yeah, if you've got no money, then okay. But remember, ask yourself a question. Did I want to get into a lettings business? Because that's what rent to rent is. Okay. Or did I want to become a professional investor? Right? Service accommodation, if you're doing a rent to rent or service accommodation, it's even dangerous. Service accommodation in the downswing will have major repercussions. Do your due diligence and homework. Don't be fooled. If you ever meet anyone who says SA is great, do me a favor. And I'd love to hear from people. Get a spreadsheet of current bank accounts and how that money is translated through. Because what I've found is those people that have done SAs, they eventually find that actually they make the same amount of money or just a little bit more than a buy-to-let, and it's been a headache as well for them. So don't chase a shiny penny. Okay, the winners. This is the column that we want to be in. Okay, sticking with me, you will be in this column. Cash buyers who keep their powder dry, having a good equity buffer, understanding market conditions, maintaining the properties to a good standard, At the end of the day, it's your property. So take pride in that, and I'm sure all of you take pride in that. All the new investors do take pride in that. High yielding properties. So maybe you've got a buy-to-let which you can convert into an HMO. I've got friends in Bedford, I can say Bedford, who have basically converted some of their properties into HMOs because they've increased their cash flow. That increased cash flow cushions you, gives you a good cushion for if there is a downturn, basically. And cash flow is all important, which you can tuck away to find deals when the opportunity arises. Have multiple exit strategies, a good credit score, like I explained, understanding due diligence as well. And that's where we're very good. And I hope I've been able to demonstrate to you the amount of depth that I go into. And I gave you an insight of how my mind works. You know, it's a very complicated place, and it will give you a full inclination of how deeply I think about things. Okay, treat property like a business. So where are the opportunities? You know, so this is a recent article. So if you look, prices in London have been dropping. Okay, there is a reason why, and also in East Anglia, you know, Cambridge is suffering. Also, you know, prices in Oxford are the fastest dropping at the moment. The main reason why is they went up, you know, they went up a huge amount. Cambridge will suffer that as well, but you can see that the biggest drops have been in London, and I think bigger drops are to come. Okay, the reason why the north has gone up and certain parts of Wales is because of the yield, guys. So people from London have been chasing yield because they want a higher yield, especially with Section 24. So what you've had is an influx of people maybe selling their properties in London or now buying new properties outside London with a higher yield. I have done mentorships in Glasgow, Scotland. I've done mentorships all over the UK. And this is where I love it. The reason why I like doing mentorships is it gives me a good flavour of what's going on in the market. But I love doing that. That's me. So, you know, if you look at this map, you'll see that, you know, at the moment, Northeast is still dropping. Yeah. So people in Humberside, Sheffield, they've got the old industries. That's not to say all properties in Sheffield are dropping. There are some areas that are rising. So don't take it as a blanket. It is a case of doing your due diligence because you're still going to find areas where prices are increasing. And equally, in some of these green areas, you're going to find areas that prices are decreasing. So, for example, if you take Wales, for example, so I think in Wales, it's where Tata Steel is, I'm not sure, I'm trying to think, Port Talbot, that's it. So if you look at prices in Port Talbot with British Steel, making, you know, and suffering at the moment, prices are dropping, right? But that doesn't reflect what Wales is doing, right? Because it is dependent on the local area and how to do that due diligence. Again, I'll explain to you later on how to do that due diligence when you work with us. Okay, so that's understanding opportunities and where they are. Okay, so what I want to now is give you a brief insight into what Infinity Wealth is all about. Infinity Wealth was really created because I am fed up of a lot of people, who haven't got the experience but are doing workshops and everything else. But equally, I'm also fed up of people who charge exuberant amounts of doing courses. And I know of plenty of people who've paid tens of thousands of pounds to do courses and they've gone into debt on their credit cards. I disagree with this whole principle. I always have. I think it's fine to go into debt in order to create income. I don't think it's fine to go into debt to do a course. We at Property at Infinity Wealth do not ever want you to go into debt. So our workshops are priced very, very competitively. So what we will have is workshops in buy-to-let, HMO, flipping properties, lease options, joint ventures, auctions, commercial properties, and much more. I am very, very market current. So if I feel an opportunity and I feel that there's a good opportunity in this particular field, I will, and it's not shiny penny syndrome, make you a millionaire. It's making you become a professional investor and understanding a professional investor. Okay, so our workshops. If you're in London and you're in Holborn, we want to do free courses, free topics and seminars for you for 2 hours. So it's almost like a free property meet where we meet every month here in Holborn. And what we'll do is I'll present a course, not a course, but a talk to you about current market conditions, where I see the opportunities arising, and then we'll have a Q&A, and then we'll also enable you to network. It's completely free and it's on us. But obviously, you've got to become a member to understand when that's going to be. What I'd like from you actually, guys, is I'm not sure whether to have it at the weekend or whether to have it Monday to Friday in the evening sometime. So it'd be great to find out from you guys to say, well, it would be better in the evening or not. We are discussing when to have that at the moment, but the next one will be up soon, basically. So it'd be great to have an insight from you to find out. We do advanced workshops. So our advanced workshops are a full day. If we've done a few workshops already, and you should see the comments that people have made. What we tend to do in our workshops is keep our workshops very small. We are not these companies where charge them high, pack them big. I don't want to know. What I want to know is I'd rather have 20 people in a room interacting, full day seminar without the bullshit, because there are so many people that pad everything out. If you've been to a course, a 3-day course, you know, and I know, most of it is padded out to make you feel, oh, you're getting value for money. And that's why they do it. And that's wrong. With me, time is money. What's important to me is actually getting the information and implementing that information, right? So we at Infinity Wealth are more about implementation on how to take advantage, what to do, how to do it. So what in our workshops, they're very interactive. They're not just sit and listen. I will be giving you work to do. And the reason why is teaching you, then saying, let's do it. Let's get on with it, and let's start that. So those advanced workshops, and we've got one coming up, are £499. Now, we've also got a full year subscription. We haven't launched all the workshops, but we will be launching all the workshops that you've seen. We tend to launch the workshops where I see the market is changing and I think, okay, let's do that workshop. So if you think, how much have people spent on courses? Whichever company it is, we're offering you 7 advanced workshops and more. There will be more for 3,200. That is, and the other thing is, it's not people who don't participate in property giving the course or want to do the course because they need to raise some money. I don't need to raise money. I do that because I like doing what I do, right? And that's why I've tried to keep the prices low. Okay, and it's only available to 20 people a month, and that's it. And it's very interactive. So if you are interested, let us know. Please send us an email to info@infinitywealth.me. And what we will do is we'll come back to you. The next advanced workshop is in auctions, and like I said to you, I'm very current. So the reason why auctions has come up now, and even in London auctions, there are some auctions that are good, and there's some auctions, they're all very good, but what you'll tend to find is that the valuation and the asking prices in some London auctions go for more than other auctions. So I'll teach you which auctions to actually go for, because they have a higher rating, basically. Not a higher rating. Investors go to these more. So it's actually understanding which auctions to take advantage of, where you possibly find that deal. Okay, so the auction course is on the 26th of October. So if you'd like to attend, and I would recommend attending, especially now, because it's taking advantage of opportunities that are going to be arising maybe months' time. If it's a hard Brexit, what are you going to do? There's no point doing it then. That's why we're doing this course now, basically, the workshop now. Okay, so what will you learn in this workshop? It's understanding how auctions work. Now, I've been in auctions for a long, long time. I'll tell you now, I went to Hastings in the 90s, looking at drug-infested places in Hastings, where property prices were low because London was really expensive. And I didn't buy, mainly because I was doing trading at the time. But I went down there, I could see the opportunity. So Clive Emerson's auctions, I've been to all of them, smaller auctions, bigger auctions. And what I'd like to do is discuss the different forms of auctions to enable you to understand that better. So what is, what is a modern day auction? How does that work? How do normal auctions work? And it's preparation work that you need to do. It's to protect you. Above all, it's to protect you. Because if you go to an auction unprepared, and don't be scared at buying auctions, okay? I am not. Even if if you're worried about buying at auctions, there are bridging ways. As long as it washes its face, right? And you do the numbers correctly, there's nothing wrong with also taking out a bridging loan. There are bridging companies there as well. So it's understanding the prep work that you need to do before auctions and where you can possibly find money as well. Auction strategies. Now, I've used this. Most of you flick through an auction catalog, and it's not in this auction thing. I will also be teaching you about, okay, there's houses that you can turn into HMOs, and it will be a brief indication of the houses, the sort of houses that you can look for. It will also be talking about ground rents. Now, most of you are not aware of ground rent strategies. There are various ground rent strategies that people are using. Very smart investors, not the ones that do the courses, but the smart investors. We've been using this, okay? So there's ground rents, also developments as well. So there are, in auction catalogs, you will see developments, but how to find out if it's a good development or a bad development. We as professional investors sometimes buy properties that haven't got planning, but equally, we also buy properties that have got planning. And guess what? In a downturn, down circuit, bottom of the market, sometimes it may be better to actually buy one with planning because you pick it up cheaper, right? But it's understanding that. Due diligence in auctions, most important. The other thing I forgot is short leases, how to take advantage of short leases and what to do in auctions. So, there's so many deals out there on the short leases as well. And it's understanding what to look for in a short lease, how to do it, basically. Okay, doing your due diligence in auction properties, because a lot of people make mistakes, and reading the legal pack, understanding the jargon in the legal pack. Now, I don't normally go to a solicitor to read my legal pack because I've been in auctions so long, but I will convey that information to you. So you can see what to look for in a legal pack. So you're not scared going, well, I don't understand it. It's all this legal stuff. You will understand. So I'll explain that to you as well, okay? And above all, it's to keep you safe in auctions. What to look for in auctions and how to be cautious. Now, there's many auctions that, there are some dogs in the auctions, let's face it. People get offload properties in auctions that are a problem, right? But I'll give you an example, actually. Let me give you one example. In Northampton, which is one of my investment areas, now this is going back, it's probably going back 5 years, I think. It was in one of the auctions. It didn't sell, guys. The reason why it didn't sell was because it had a tenant in there who wasn't going to move out, right? Now, it was a blinding deal. So I'd phoned up the agent and I said, look, I'll offer the asking price. This is what I'll offer. Unfortunately, it went into a bidding war because someone else saw the opportunity as well. Now, that tenant, even if you'd removed that tenant, that property would have been worth more when you had done it up. So today, that property is probably doubled, or more than doubled in price now. So that was in an auction. So it is finding deals in auctions, but also understanding where, okay, you might have a slight problem with this, but the uplift is great. So it's worth sacrificing that hardship at the beginning. But it's understanding where to do it and when not to do it. Often auctions pay games. So it's understanding what sort of games. Now, this can vary from small auctions to big auctions, right? So it's understanding what sort of games that they play as well in auctions, yeah? Problems that occur and how to avoid them. There's loads of pitfalls in auctions, guys. And I have known people who lose their 10% deposit because they haven't done the numbers. They haven't done their due diligence. They haven't understood what is going on. They've just seen homes under hammer and thought, yeah, I'll buy that. It's not about that. It's about being professional, and we will keep you professional because that's what we're about. Okay, we'll go through live catalogs. So what I will do, and I will also ask you, if you're interested in a particular property in an auction, bring it with you. So I will give you work to do in that. It's a very, very interactive workshop. It's not you sitting there listening to me. It's me conveying all the bullet points, everything, making sure you understand, and then, especially the numbers, and then getting you go through and saying, okay, where do you see the opportunities? Because then I will show you where I see opportunities in that auction. So it's really getting you inside my mind. from a professional point of view, which will give you more of an insight what to look for. I'm sure that you'll agree that will help you. Okay, so that's what we'll cover, and there'll be a lot of content. It will be a full day, I promise you. We only have a 45-minute break, but if you are interested, please get in touch with us. Once again, it's on the 26th of October. It's only £499. Now, lots of places will charge you huge amount. That is not a huge amount of money, considering how much it can save you in getting wrong in an auction. Just think about the 10% deposit that you could lose. That fee is a small fee to pay. And like I said to you, we've only got a room full of 20 people, and that's all we do. It's very confined, and it's very interactive with me giving the talks, no one else. Yeah. Okay, so I hope you've enjoyed the webinar. And now we're going to take questions, basically. So if you've got any questions, yeah, if you guys type them in, I've got Kiki on the laptop who's going to read out any of the questions that you've got. Look, it's a closed room, so let me know what questions you'd like to ask me, and I'll answer.
Got a few that people have been asking.
Okay, yeah, go ahead, yeah. So what you got?
So if anybody else wants, just type it in.
Yeah, if anyone else wants to type in questions, that's great. Just type the questions in, and we'll cover them.
Yeah.
Right. So Kiki will read them out to me.
Okay. So number one, what property strategies would you avoid or be wary of in the lead up to Brexit, post-Brexit?
Okay. So what sort of strategies that I would be aware of is I wouldn't want to do a development right now. Okay. The reason why is because right now, I think if you do a development, property prices are still higher than they should be. So one of the strategies, we've done developments. So I and my friends have sat on our hands thinking, okay, we've done that development last year. That's great. We'll just hang out. Don't get me wrong, if there's a deal to be had and there's plenty of buffer, we'll do it. But one of the main things is developments, right? That is what I'd avoid. But, the smaller flips, and when I'm talking about developments, I'm talking about the larger developments, okay? I'm not talking about flipping a house. As long as you've done your numbers, that's great. But that's because don't forget, after Brexit, we will hit recession point. House prices are going to be doing that. So if you've done a development, your GDV is up here, and now it's down there, and your numbers won't work. So that's what's important. So that is probably one of the strategies that I would not do. And also rent to rent. And SAs, well, I wouldn't quite do them right now. Yeah?
Okay. Second one, there's talks of flips being risky, but are there certain types of flips that may work?
Yeah, absolutely. Absolutely. So who was that?
We're not going to say names.
Okay, we're not going to say names. Okay. Yeah. So, yes, there are certain types of flips. So let me give you an example, okay? So right now in the auction, Kiki and I went to an auction. There's another one coming actually, so I might go to that one as well. And yeah, so in auction, so there was one that was basically a short lease, basically. And because you have to be a cash buyer to buy the short lease one, there was plenty of margin. So I wouldn't be the most important point in flipping is that you've got to build a buffer. So let's say your done up value, hypothetically, is, let's say, 400,000. You and I both know, in a recession, everyone's looking for a deal, right? When everyone is looking for a deal, what you want to do is make sure that even at let's say it's 400, even at 375, 365, it still will sell and you will still make a profit. That's what's important. Now, too many people go, oh, it's okay. It will make, I can get 400 grand, not realizing what market conditions are doing. If you've done your numbers, and remember, if you've done your numbers, what you'll find is that you may have to reduce your asking price because everyone wants a deal at the end of the day. So, yes, flips work. I would actually tend to do smaller flips, right? So if you look at what I tend to do is, in a downward cycle and we're projecting up, I tend to look for the bigger stuff. In a downward sloping, if you do a smaller development, at the end of the day, it's going to keep you safe. You're not going to lose your shirt. Lots of developers lose their shirts. Remember that. Development is a high risk game in certain types, and it's high risk anyway if you get it wrong. And you really need a certain type of mindset to be a developer. So I would say to you, yes, flipping is possible, but it's all about doing your numbers. Yeah.
Okay.
So I hope that helps. By the way.
Yeah. Okay. So they're saying get a bit closer to the mic.
Oh, get a bit closer to the mic.
No, me.
Oh, you.
And I'm saying the question.
Oh, okay.
So the next question is, when do you think would be the best time to invest, as you don't know where the bottom is?
Okay, right. So, yeah, you're right that we don't know where the bottom is. You're absolutely right. But you know the indicators that I showed you, right? So just put yourself in this scenario. Scenario A. What we've found is that we've got a hard Brexit. Okay, hard Brexit. We now reduce interest rates to 0. Okay. What you'll still find is that there will be people panicking, right? There'll be people panicking, not buying, right? And it's not the time to, it's actually to sit and wait. I've been a trader as well, right? So it's waiting for opportunities to come to you rather than delving into a thing that you think is an opportunity. So that's what I would do. I would definitely, with what you'll find is that house prices will start to come down. Interest rates, if you were around in the last recession, what you found was the savvy investors and all the professional guys who knew what they were doing, when interest rates went to 0, if they go to negative, that's great, right? If they went to 0, what they were doing is they were just sitting it, because most people were going, okay, I'm really scared, because news flashes were property prices are dropping, property prices are dropping, property prices are dropping, and everyone was scared. That's the time to go in and buy, right? So it's understanding market cycles. So you yourself, I mean, one of the things that, as a trader, I don't know if any of you have done stocks and shares, we will be at Infinity Wealth, we will be doing that as well. But, there was an old added saying that, when a taxi driver in New York tells you to buy the stock market, it's actually time to get out and you're at the peak cycle, right? Equally, when everyone is telling you how bad house prices are, we're going to go to hell, that's the best time to buy. And if they've already reduced interest rates as well, go with it. That's when you're going to pick up the deals. What's the next question?
Okay, super. All right, so this is a mouthful. How do you think the property market will be affected in the north compared to London? In London, you may have a sharp decrease, but doesn't that take a while to reach the north areas? And how do you time that?
Okay, so in 2007, I don't know if you're a London investor. In 2007, London property prices had a huge dip down, right? Well, huge, 10% maybe. That was a V-shaped recovery. And the reason why it was a V-shaped recovery was because interest rates were dropped. All of a sudden, down to, 0.5%, right? They were dropped very quickly from 4.5%, 5%, all the way to 0.5%. So that recovery, and at that time, London was still, well, I wouldn't say affordable, but it's not where we are now. The main problem that London has is the affordability index. If you look at house prices in London, they are more unaffordable than the houses up north. Now, a lot of people are worried about buying up north because they're thinking, well, if prices drop in London, then they're going to collapse up north. I'm not so sure whether that will occur this time round. Now, I am sticking my neck. I'm not 100% sure. The reason why I'm not 100% sure that it will occur this time is because of the affordability index. Now, London has got, it takes a lot of weight, a lot of multiplier in order to be able to afford a house in London. Don't get me wrong. I think London prices, over the next few years will stay where they are. I think there'll be chances to pick up deals in London. But if you look, if your interest rates are near 0, let's say, right? When they're near 0, you're getting a decent yield up north, right? As long as you've got people who can rent up north from you, then it's fine. What you'll find is that before, London prices, as soon as they turned, the rest of the country turned. Actually, London turned 2 years ago. We noticed London turning 2 years ago, once Brexit was announced, Lots of people, when that stamp duty threshold was announced, went off and bought loads and loads of properties, trying to avoid the stamp duty. Yeah, they're in negative equity now. So what I would say to you is, it's all about, London. I think with London, you've got to be reasonable about London. It's all about buying right in London. It's not about timing. It's more understanding. You know, you may find, okay, so let's say hypothetically we get a hard Brexit in October. Hard Brexit is there. That's great. You won't buy as soon as hard Brexit is announced. You will buy when there is pain and blood on the streets. They say that in stock market trading, and that is also true in property as well, right? And that is when you know you're at the bottom. Yeah?
So next question is sort of linked to the one.
Sorry.
Is should we invest in the south where the capital growth benefits quicker out of a recession, or should we invest up north where the yields are higher but the capital growth is slow?
Okay, good question. Very good question. Okay, I hope you all heard that. Okay, so it all depends on your strategy, guys. At the end of the day, if you like your job, right? You like your job, and what you're doing is to build a little pension pot, but you don't want to leave. You don't want to leave your job, and it's more important to have a balance between income and also capital appreciation. What you're going to find is that you're not necessarily going to get capital appreciation up north, right? You'll get some, but you won't get a whole amount up north, right? Whereas in the London and the southeast, you will. So there's a little balance that you have to trade off, and that trade-off is, do I want, and I can't decide that for you. It very much depends on, you know, if you've got a strategy where you just want passive income to get out of your job, you hate doing that, and you want to become a professional property investor, then it's worthwhile actually investing up north to get the higher yield, basically, to enable you to leave your work earlier. Whereas you could already be in London, in a great job, you've got lots of money coming in, you don't want to leave your work, but what you want to do is secure your kids and your future a little bit more because the pension's not working out. Then it would be a case of finding the right area within the London, within London and the southeast. It's not just London, right? Because there will be plenty of opportunities. So that will be, it very much depends on strategy on that and what you're after.
Super. Next question. So we've got 3 more to go.
Okay.
Next question is, where do you think investors should be investing their money? HMO, SA, AST, and bearing in mind the low interest rates, shortage of homes, and low unemployment.
Okay. So, first of all, I'm not sure about service accommodation. Okay, I'll tell you now. Okay, because I told you in a recession, you're competing with hotels, right? So the first thing is do your due diligence, right? When I stay, if most of you are staying in hotels, right? In an SA, you're in quite a confined environment, right? Okay, granted, the rates are a lot cheaper, but in a recession, hotel rates are going to drop anyway. You've got better Wi-Fi, you've got amenities at your disposal as well. You can come and go, right? Most people are going to, and you've got parking as well. That's, you know, that's the other thing. So my thing is, I'm not a big fan of SA, but if you've got a large enough and you want to create a hotel, that's fine. Then you are able to do that. What was the other part of the question?
So where do you think investors should be investing their money? HMOs,
okay.
Accommodation.
So I like HMOs, guys. I also like flat conversions. Now with HMOs, you've got to do your due diligence. Now one of the things is, look, I've got properties in Kent, right? There is a saturation. What I've noticed, and some of you who've already into HMOs, you'll probably find that your HMOs are getting harder and harder to rent, right? That's because there's been an influx. So you've got to do your homework and your due diligence, not necessarily just rush into an HMO. I like the HMO strategy. I like the flat strategy. I really love the flat strategy because it's actually, you know, I have less churn. In fact, I still have less churn on my professional HMOs because of the prices I'm charging. On some of the professional HMOs, I do have a bit more churn, right? Because the market conditions there have changed, but I bought them ages ago, so I can actually sit on it, yeah? But the strategy, again, is why are you doing it? Are you doing it because you want X amount of free cash flow, let's say £2,000 a month? Then obviously you want that free cash flow. So if you want that free cash flow, what's going to get you easiest to that cash flow is going to be HMO. Whereas if you like your job, you've been, and you don't need it, what you want is the uplift. Then as long as you're getting a decent amount of return, covering everything else, and you've done your due diligence, and even at 6% it works out, then you could just buy a standard buy-to-let around the southeast and wait for appreciation, or even in London where you can pick up a deal, right? So I hope that's answered that question.
Yeah. Okay. So what do you class as a small development?
Okay, all right, that's a good question. Listen, even doing a flip, where you've turned one house and you created 2 flats out of it, doing an extension at the back, it's still development, guys, because you've got to do groundworks at the back. You've got to do that. So that is a form of development at the end of the day. The ones that I like are flats, right? HMOs, there's quite a few around. But again, HMO strategy works in London. It really works in London. But HMOs, rents in London are dropping. And rents are dropping in London because of increased competition. I know that people are saying more people are leaving the market because we've had a lot of Eastern Europeans move back home, basically, because they're unhappy in the UK and how Brexit is going. Equally, we've also had more come in. But in London, we've suffered that, especially with the high cost of living in London. So they are looking for deals. So HMOs work in London as well.
Okay,
yeah?
Cool. This is more, people want to get a bit more in depth. So
Okay.
why is it specifically not a good market for rent-to-rent and rent-to-rent service accommodation at the moment?
Okay, so the reason why it's not a great market at the moment is in a recession, what you'll find is when you've done a rent-to-rent, you've guaranteed the landlord X amount, right? So hypothetically, let's say you've got I don't know, 4-bed in, let's say Slough, right? Let's say you've got a 4-bed in Slough. The rent in Slough for a 4-bed is something like £1,200 maybe. Okay, so you're guaranteeing that landlord that rent. Now, the problem is that you'll find is that there'll be less, the number of people working in a recession is reduced. So the number of people moving as well is going to be reduced, right? So if you've already got that liability to pay that landlord £1,200 a month, and what you tend to find in rent to rent is probably your last room that makes you that money, right? Because you've got to cover that bills. Unless it's a huge rent to rent deal, then it's different. But generally, it's maybe your last room or last room and a half that will cover and give you that cash flow, that £600 a month cash flow. So if you can't rent that room out, which is more likely in a recession, then does that really work, right? In a good market environment where you've got plenty of job opportunities, you've got people moving between jobs, that's great, right? So you've got to have those influx of people, basically. Yeah, and equally, that's why SAs, hotels in London, if you've lived through recessions, right, you'll find that hotels do deals in recessions. So now an SA is competing against a reputable, recognised hotel which has good marketing strategies far better than you. Yeah. How are you going to compete with that, right? So I hope that's answered it. I hope you've enjoyed it as well, guys. So if you've enjoyed it, please share us.
Any last questions?
Yeah, and any last questions? We're here.
We'll give them a minute.
Yeah, any last questions that you thought of? Please, please just type them in, and Kiki will call them out.
Yeah, we'll give you guys a minute. So if there's any last questions that you guys have, just type them in the box, and then we'll be happy to answer. So just wait, please.
Yeah. So once again, I hope you've enjoyed it. We are trying to be disruptors in this industry, and I hope you see, the level of experience that I have. Disruption in the terms of prices. We don't want to. We want to supply value. That's where we're at. Yeah. That's our main goal. Our clients are our most important goal, right? And having that reputation that people come to.
You can go to the next slide.
Yeah? Okay. Okay, so guys, we'd like you to support us. We've got a YouTube channel. So in that YouTube channel, also there'll be another video out. We put out video every week. And we'll also be talking about different strategies. So I was talking about Bank of England. Please subscribe to our YouTube channel. So, it's at Infinity Wealth. We've just launched recently, but I hope you've understood the depth that I go to and the quality of the information that I supply you above all. So please subscribe to our YouTube channel, which is Infinity Wealth on YouTube. That will be great, and it will keep you updated on all the content that we're bringing in. And also, we've got a Facebook page as well, so please subscribe to that, and also Instagram. Yeah?
Yeah, you can go to the next one.
Okay, so I'd like to thank you. Kiki and I would like to thank you for coming along and spending this evening on this webinar. It's been our very first one. I was excited, so I hope, please share it. If you've enjoyed it, please go on social media and and it will all be available on YouTube later on. So please share it. I need your help. I will give you my time. Please try and support the cause that we're trying to do at the moment.
Okay.
All right.
Last 2 questions.
We got 2 more questions that popped in.
Last 2 ones, and then we'll
Okay, go on then.
Okay, so first one is commercial or resi investment?
Oh, commercial at the moment.
Okay.
All right. I tell you why.
Okay,
I tell you why. Section 24. I do like commercial. Okay, but there's certain aspects you've got to be careful with commercial, right? You've got to really know what you're doing with commercial. At the moment, I would favour commercial more than resi. The reason why is because of Section 24, right? So if I was buying an office block or something else, I'd actually probably buy it in my own name because I don't have to have Section 24, right? It won't affect me, right? So I think the effects of Section 24 are mitigated in doing commercial, and also half and halves as well. So yes, I do like commercial. There are opportunities in commercial. Equally, residential is good as well. So what I tend to do is I don't filter myself in one. As a professional investor, I just want to make money, so I look at everything. I look at all opportunities, but I understand all opportunities. Go, yeah, I'll have that, because I can make a decent amount of money. So I'll do one over the other if I can make more money from one or the other. Yeah, but I do like commercial.
Cool. Okay, so last one, then we're going to wrap up on this.
Yeah.
In your view, what's the best strategy to look at currently?
Okay, that's a good question. Okay, so at the moment, looking at what's going on, with the new PD rights as well on commercial. I think it's worthwhile having a look around there, seeing what you can find within that commercial arena to see if there are deals to be had. So for me personally, I would be looking at that. Don't get me wrong, I am also looking at anything that I can pick up really cheap. And that's why I am going to auctions, because auctions are enabling me to gauge the market, but also to see if there's an opportunity. And, at the end of the day, on the auction, I want to pick up cheap. I'm not going to pick up full price, right? So that will be my strategy. I'll go to auctions, but also, I'll explain to you what ground rents are. Ground rents are, in the course, I'll show you how some savvy investors use ground rents to actually get quite rich. But yeah, so it all depends on strategy, but that's what I would be doing. Yeah.
Okay, super. So I think we wrap it up.
Okay, so I hope you've enjoyed it, guys. Please go on Facebook, Instagram, say how much you've enjoyed the course. Help me, help us. We're helping you. But again, remember, you get as much content coming to Holborn. If you're, we will open it up. We're hoping that the webinars will base for everyone around UK, but we'll be doing stuff here as well. Right? But let me know if you want to do it a Saturday, midweek. What do you think would be the best day? Yeah? Okay, listen, thank you guys for your time. I am eternally grateful that you've taken time out this evening to actually listen to me. Thank you.